So Japan just flipped on its interest rate policy, and this could have a huge effect on the US economy.
The Bank of Japan is expected to unwind its negative interest rate policy in 2024, and the fallout in US Treasuries could be huge.
So Japan just declared that it's ending its negative interest rate experiment that it started 7 years ago. And the theory is that it will have an impact on the US economy, on our debt levels, and our interest rates. Now this gets insanely complicated, but I'll try to keep it simple because this story technically started 7 years ago. Picture it, the year was 2016. It was the year of the presidential elections, the year the United Kingdom voted to leave the European Union, and it was a pretty crazy year. At the same time, the US economy was starting to heat up, and the Federal Reserve was worried that the US inflation would grow at a faster rate than what they want, which is 2% per year. So to slow us down for the coming years, they started to slowly increase our interest rates, which at the time were basically near zero. At the same time, on the opposite side of the world, Japan's economy had the opposite problem. They had negative inflation, and their prices were falling, which is bad because whenever consumers see that prices fall, they don't want to spend their money and they'd rather wait until tomorrow, which means the economy doesn't grow, so prices fall even more, and this continues and perpetuates this never-ending problem. So while the rest of the world was raising interest rates, Japan had the bright idea to lower them instead, but lowering them not just to zero like the US did during the pandemic, but dropping the rates to below zero into negative interest rates. It was the start of something called YCC, the Yield Curve Control Experiment. Now, in the context of economics, the yield curve has accurately predicted 10 of the last recessions since 1955. So the theory is, if someone had the power to control their country's yield curve, they might be able to prevent recessions and artificially grow their own economy. And that was the start of the ultra-loose monetary policy that is sometimes referred to as Abenomics. Well, this year, though, marks the end of that experiment, and some economists are worried this will put a pressure on the US and by extension, the global economy as well. So that's what I want to try explaining in today's video, so let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for Japan, which brought me some of my favorite childhood experiences of all time, like Super Mario, Pokemon, Legend of Zelda, Street Fighter, Final Fantasy, and now the US recession's greatest hits, the Millennial Edition. Just kidding. Hopefully. So here's what's going on. I'll try to talk kind of slow in this video because it gets insanely complicated, but these videos are really hard for me to make because I don't fully understand the complexity of it all, but I'll try my best to explain. Let's start with negative interest rates though, because how can rates be negative? Because here in the US, interest rates for a 30-year mortgage reached 8% as a national average. And even back when rates were close to zero, the lowest I've heard anyone have is like a 2.5% mortgage rate. But if rates are negative, does that mean that people get paid to borrow money? No, but that'd be cool though. So what this is referring to is just the cost for banks to park their money with the central bank, the BOJ or the Bank of Japan. Now, this is just a way for Papa Bank to incentivize all the baby banks, the commercial banks, to lend out their money to their citizens instead of hoarding it for themselves. This way, by creating an environment of cheap money, it encourages people to actually go out and borrow money so they can build a business or buy a house. This was their attempt to control this yield curve. Now, the yield curve, by the way, if you're not familiar with it, is just a graph that shows the difference between lending money in the short term versus the long term. And in a healthy economy, it should look something like this. Lending money for the long term is more risky, therefore interest rates on long-term lending will be higher. That's a normal yield curve. Think of it like this. If your friends asked you to borrow money in the short term versus the long term, you treat it a little differently. Like if my friends came up to me and asked me to borrow money for 10 days, I'd give them the money and I wouldn't even worry about the interest. But if they asked me for 10 years, I'd be like, you better pay up. But if that situation is reversed, and you start to charge your friends more for just 10 days, that means you probably don't think your friend will be your friend in 10 years from now, or you don't trust them as much, so of course you're gonna charge them more in the short term. And that's bad news. And when the yield curve in the bond market flips like that, it usually means a recession is gonna happen at some point. And spoiler alert, the US has been in this inverted yield curve for a while now. But Japan figured if they could somehow control that friendship and maybe buy a couple friends, by way of suppressing their short-term interest rates for their bonds, that their long-term bond rates would just have to be higher. Kind of like if you go through life having low or maybe negative expectations, in the long term, you'll be pleasantly surprised. And that's also how I won the Most Improved Award. I digress. It's probably a bad analogy, but you get the idea. And now Japan's experiment of keeping their short-term interest rates low is coming to an end in the first half of 2024, and that's what people are afraid of. Okay, so now the question is, why are some economists afraid if Japan raises interest rates? It's not like it affects our ability to borrow money, doesn't affect the US that much. Not a lot of people know that the way the United States borrows money is by issuing or creating treasury bonds. And when it creates those treasury bonds, it needs investors to buy those bonds. Well, how does it do that? By making bonds have higher and higher interest rates so that we can make more money. And the way to do that is for the Federal Reserve to increase interest rates. And as we know, when raising rates, you affect unemployment because more people could lose their jobs. It makes it more expensive to borrow money and open credit cards. And it makes US debt much more expensive because the interest payments start to go up. So much so that the US has to borrow even more money just to make the payments on its interest. And a lesser known fact about all this is that the biggest buyer of US debt also happens to be Japan. And that makes perfect sense. If you're an investor living in Japan, or you're a life insurance company or a bank and you have this money, you don't want to put it into the JGB, the Japanese government bond, because that's paying you less than 1% on your money. In some cases, they are charging you to put their money there. So instead, you're going to look for something that pays you a juicy yield, something that's stable, and something that's been known to never default on its debt. And at the top of your list would be US Treasury bonds. That's also why Japan has been the biggest buyer of US debt. They own 147 trillion yen, or about $1 trillion worth, which puts them at the global top among all the other countries in the world. So economists are worried that if Japan raises interest rates enough to be competitive, it would discourage our biggest buyer, Japan, from buying our treasury bonds, and it might even incentivize them to sell off those treasury bonds instead. And that's why right now there's some price instability or volatility in the bond market. Because the world right now, especially the banks, which are some of the biggest holders of US debt, aka those treasury bonds, are saying to themselves, wait, so if Japan starts to sell off those treasury bonds, does that affect my US treasury bond portfolio? And of course it does. Because if an entire country starts to sell off those assets, it would negatively affect those bonds as well. So that's impact number one. Here's impact number two. If the United States keeps borrowing and keeps spending money like it's doing at a record drunken sailor pace, it means it would have to increase interest rates even more. Because in order to attract those foreign buyers to buy our bonds again, we have to raise our interest rates. And as we've learned, the negative side effect of doing that is that it increases the payments on our debt, which means we have to borrow more by creating more treasury bonds. But who's going to buy them? Oh no, we have to raise our interest rates again. It's a continuing, self-perpetuating problem that's bad for employment, consumers, the entire middle class, and the country as a whole. Now I know that all of that sounds scary, but the truth is I have no idea what the real effects will be. No one knows because we can't predict how much Japan will sell our treasury bonds, and how much will they increase their interest rates by. Will it be enough to stay competitive or dissuade Japan from buying our thick boy juicy bond yields? No one knows. So to calm us down, I'm going to give you some of the counter arguments for why some people think this might turn out to be a nothing burger in the end. And one of the reasons why this could end up going nowhere is because of debt. For example, Japan has a 263% debt to GDP ratio, which is the highest of any developed country in the world. It owes roughly 2.6 times what the country makes in a single year. And that should give Japan a lot of reason not to raise rates too high, because having those rates too high means their interest payments on their debt will become that much more expensive, which would also make it easier for them to default on their payments to their bondholders, which they don't want to do. But reason number two this could end up going nowhere is because Japan does not want to see the failure of its own banks. And we saw that happen in the US earlier this year, and just as recently as this past week, we had another smaller bank fail in Iowa. Because the US raised interest rates too high too fast, it made a lot of banks go insolvent. And they became insolvent because they parked a lot of customer deposit money into treasury bonds back when they were paying a very low interest rate. So when the Fed started to increase interest rates, the value of those bonds started to go down. So when people wanted their money back, they couldn't give them all of their withdrawals, and so they failed. And that's what the Bank of Japan should be very careful of repeating that same mistake. Now, the third reason why this might end up going nowhere is because of public debt, specifically mortgage loans with variable interest rates. For example, when I bought my rental property, I bought it with a 7-to-1 variable rate. That means my rate is locked for 7 years, but after 7, it will have one adjustment. Whatever the rate will be in 7, that's what I'll have to pay. And a lot of people did that to lower their monthly payment. The problem with doing that, though, is if you miscalculate in the future and you can't afford your monthly payment, which could have doubled as a result, then you could end up losing your house, and that's not something a country wants to have happen to its citizens. And reason number 4 why you'll have to be extra careful is because of the stock market. So check this out. When Japan raises interest rates, that will make the yen stronger against the dollar, which sounds like a good thing for Japan. But when Japan's private sector sells all the products overseas, and it converts the dollars that it's made back into yen, they'll have less yen for it. That means those private companies will make less money. They're less profitable, which hurts the stock market. But who does that ultimately hurt? You'd think private investors. But believe it or not, the number one investor in the Japanese stock market is the Bank of Japan. That is bananas. That's like the Federal Reserve being the number one shareholder of the US stock market. That's another huge reason why the Bank of Japan wouldn't want to raise interest rates too fast, because it doesn't want to hurt itself. And frankly, reason number 5 why Japan may not even sell US Treasury bonds all that much is because they are worth less today than what they paid for them. So they don't want to sell them at a loss. Now, there's a lot of other complicated reasons that I won't go into, but the point is, sure, this could have some negative side effects on the US economy, but overall, probably not as bad as some people expect for it to be. All in all, if I could share my own opinion about all this, if I were a betting man, I would say this entire situation with Japan probably won't have that much of an effect on the US economy, and will still keep going on the same path. We'll still continue kicking the can down the road if we have to. We could lower rates to 0 and indefinitely keep going. And I don't think this will be the match that lit the fuse, so to speak. It's still not the best thing to have happened, but I still think it's important to understand what's going on with the economy and how it could affect the world. But I hope all this helped you understand just a little bit. And as always, I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks. Links are down below, and then go track them automatically with a spreadsheet link down below in my Patreon. Love you. Thank you so much for watching this video. I'd love to see you back here on Monday, Friday, sometimes Wednesday. See you soon. Bye-bye.